Welcome to Clearway Capital Solutions' new podcast series. I'm Dennis Mothoneos from Clearway Capital Solutions, and I'm joined by Mukhtader Mohammed, co-founder and managing director, and Blake Ammit, managing director of Arbitrium Capital Partners, a private credit specialist manager, to answer 10 plus 1 questions about Arbitrium Capital. As some of you might know, Clearway Capital works closely with Arbitrium Capital in helping them to grow and maintain their business in Australia and New Zealand. Mukhtader, very briefly, tell us about the history of Arbitrium Capital and what it does.
Sure. Thanks, Dennis. Arbitrium has been around for 16 months now. We started in September 2020, and Arbitrium is a credit fund that specializes in opportunistic credit and special situations credit transactions. We only look at or seek loans in Australia and New Zealand. And we look to add value through our operational and turnaround capabilities, aside from just our structuring capabilities.
But what is the market opportunity Arbitrium is hoping to take advantage of?
Dennis, I'd sort of say it really follows that whole thematic that, the major banks are really withdrawing from sort of mid-market corporate lending. So non-bank lenders such as Arbitrium's filling that sort of void that, we sort of see it that, above 100 million Australian dollars, there's plenty of international players that, will get involved in those sort of assets. But once you get below 100 million Australian dollars down to about $20 million, which is our sort of target market, that's where the opportunity is. So it's really that $20 to $100 million cash flow lending is really the opportunity, and we see it for years to come.
Are there any points of difference between Arbitrium and other private credit special situation managers?
Arbitrium has 3 key points of differences with other private credit or special situations managers. And I think these fall under the team's active management of the investments, our location, and our deal sourcing capabilities. So when I say our active management, it's not that the team stops after the heavy involvement during the due diligence process before a deal is closed. But after a deal is closed and the investment has begun, the team is actively involved throughout the life of the investment. This is maintained by weekly meetings with the borrower's management team, reviews of trading performance on a weekly basis, reviews of the weekly cash flows over the life of the project. And Arbitrium's main priority is capital preservation for its investors. So the active involvement in our investment business or in the borrowers allows us to identify any issues and then mitigate those issues in time. The location is another advantage that Arbitrium has to other special sets of private credit managers. We are domestically based, and therefore we have boots on the ground. And given our investments or our borrowing entities are all based in Australia or New Zealand, it allows us to go and conduct our due diligence in a more detailed manner with these businesses. Also, given the domestic location of the fund, there is no currency hedging required to the investors here. And finally, our deal sourcing is another key differentiator where the Arbitrium team are able to source good quality deals ahead of other credit funds or special assets managers due to the team's direct relationships with banks, advisory firms, and C-suite executives at mid-market corporates. That allows us to get first look at a number of good quality deals.
How important is culture at Arbitrium?
Yeah, Dennis, it's really, really very key. Well, it's sort of not written. It's certainly said that, we're a Melbourne, Sydney-based credit manager. Each one of us must have worked or known each other previously. So that's the mantra of Arbitrium. So obviously, Mukhtader and Daniel being the founders, worked together at Deloitte's. My last role of head of asset management, I was a client of Deloitte's, therefore met sort of Mukhtader, and then it goes all the way through, to our chair, our investment committee members, and even our advisory board. Each one of us has either worked or knows everybody in the team. So, and that will be the way as we build out the fund.
Is it becoming more difficult to deliver alpha?
Not at the moment. We sort of see that, there is that market opportunity. There's not many players in these sort of opportunistic credit and special situations credit. So we sort of have the market to ourselves, so we can deliver that sort of alpha. We've really got some first mover pricing advantage. So you see that in each one of our transactions. Plus we also, we get, these are active credits. We get heavily involved in each one of our borrowers. So that even helps deliver from not only just looking at the loan and the numerous sort of financial covenants, but getting involved operationally on each one of these borrowers really is, it's sort of testament to the returns we can achieve for our investors.
That operational involvement is a point of difference, isn't it?
Yeah, it really is when you sort of see each one of our bios that, we've been involved in equity, debt, turnaround. So we actually do roll up the sleeves and we know each one of these credits well and truly, rather than just quoting, what an EBITDA or interest cover ratio it is. We can actually tell you each one of their own sort of business opportunities and the points of difference. So it is a key point for Arbitrium.
What can private credit contribute to a multi-asset portfolio?
So we think private credit does is it provides a running yield because each of our investments have that coupon aspect, which gives you a running yield, a quarterly distribution, and then there is an upside through the enhancements we put into the structure, and that could be a warrant or a convertible. That upside only comes at exit, but during the loan investment period, investors receive that quarterly yield.
What is the biggest risks to the portfolio? What typically keeps you up at night?
As mentioned, the main aim of the Arbitrium Fund is capital preservation for its investors. So what keeps us up at night is the unknown. And by that we mean that any unknown risk that could affect an investment or either at a point in time or over the life of the investment. For example, take into account the macroeconomic risks brought about by the Russian-Ukrainian war and that impact on our investments. We have an investment in our portfolio that has a small exposure as a result of that war. So it's that sort of unknowns that could never have been predicted. And what impact that can have on our investments. Now, what we aim to do is to immediately then work out mitigation strategies for any risks like this. But that essentially is the biggest risk to the portfolio, is these unknowns, and how do does the team mitigate them working with the borrower's management team.
But and Dennis, I'm interested in your thoughts on that comment. We did speak about this morning about what keeps you up at night. So we're trying to get through the capital preservation story, and then up at night is we talked about we're going to cover everything we know right now when we do an asset, but it is the unknown. And we just came back from Sweden last week, so one of our investee companies has got, I think it's 4% of its revenue. It sells mining rigs and consumables. That is now a force majeure, so it's going to affect that transaction. It's not major, but it's the things you don't know when you write loans for 3 to 4 years. So that's part of where the thinking came from, that sort of response about what keeps you up at night.
Yep. Okay.
And his current it was good to bring that up as well. I mean, if you think of our, Blake made a good point this morning about our prawn investment. It could be hit by a prawn disease in a year or two's time. So we just don't know. We try to capture it in our investment papers. We just don't know.
Yep. How are environmental, social, governance factors integrated into the process?
Oh, look, it's a very big part of it. I've been involved in private credit for a couple of years, and initially ESG, everyone just thought it was, environmental and coal, and possibly, sex industry, but it's got a lot bigger than that. It's every aspect to it. When we first socialise an opportunity, it's front and centre, and obviously in our investment process, we spend a lot of time. And to get IC approval, we've got to cover off on each aspect of ESG. And like I said, it's not just environmental, the social and governance is getting bigger and bigger, and that can quite often be, human slavery when it comes to one of our aquaculture deals or hospitality. But every aspect, and it's not just initially doing a loan and putting it into the fund, it's also the renewal process, meaning the annual review process that if it's a 4-year loan, it means for 4 times at least we're reviewing the ESG policy of the borrower.
Does Arbitrium believe ESG can add value or reduce risk?
Yeah, it definitely does. I mean, it helps the borrower understand it, but also, we're an investor-facing credit fund, so they expect that. Our wholesale investors expect that. So it does add value. When we sort of touch on the points that we need to cover off on, it certainly helps. Certainly helps the borrowers. When it comes to reducing risk, I'd sort of say the risk, Mukhtader's mentioned about the downside risk of the loan, but the risk we've got to look at, because we have loan repayments and equity components, what we need to think about in 2022, when a loan expires in 2025, what's the ESG landscape going to be like then? So that's the risk that I'd cover off on from an investor, that we need to have a look of what the ESG lens will be in 3 years to come. So it'll be all those parts of ES and G. So that certainly, if we don't do it now, that sort of would be a risk for our investors and our expected returns at maturity of one of these assets.
Arbitrium has just started engaging with Australian and New Zealand investors. How are those discussions progressing?
Good. We've got lots of meetings. Unfortunately, by Zoom and Teams, but that'll change as we can travel more. But a lot of. Obviously, we've got high net worth individuals, family offices, and now, this calendar year, we're also speaking to pension or super funds. So we've got a lot of those. A lot of it's an educational piece. Private credit's very well known in Europe and America, not so much in Australia. So we really had to, identify the market opportunity, but also say that, hey, there are players such as Arbitrium in that market. So we're getting a good ear on that. They really have to understand that we don't do anything too mysterious, that we're really taking positions that are downside protected, but it's really a position a bank would normally take. So, so that's a well-received comment. And also, they're going fairly well because people, apart from, worldwide issues from an equity point of view, are really looking at defensive nature of their portfolio. So private credit and alternatives is probably the reason why we're getting a fairly good hearing from that.
Sure. And what is Arbitrium's medium-term outlook for the asset class?
So we find that there's a strong pipeline of opportunities that we're seeing, and we think that those opportunities or that pipeline will remain strong in the medium term, particularly because as banks continue to retreat from this mid-market area where the corporates don't meet the credit risk criteria for banks, as well as some non-bank lenders. I think we have that ability to go to take on a little bit higher leverage metrics for these corporates. If we're seeing that there will be more opportunities there.
Thank you, Blake. Thank you, Mukhtader.
Dennis, thanks. Thanks for the time.
Thanks, Dennis.